Hey, good morning, good afternoon. Morning, Bob. Hey, Sam. Hey, Dave. Good to hear from you. Yeah, life is okay. Life is good. This week was a little fun week for me. In On the office, we had our after a long time after you know now almost 3 years we had actually had our off site with a company offsite. So we had a lot of folks coming in, traveling, and it was fun to see a lot of people face to face. Half of our team we had was during COVID, never met, only discussion on Zoom. So that was really fun this week, getting to meet people in real life IRL, uh, and meeting all the colleagues in person. I would say that was a highlight of the week for me is to meet a lot of folks in person during the offsite. So that was fun, but that also meant was completely tied up because breakfast starts at 7 o'clock and then we finish it up with after dinner. So I was like on almost we had it on Tuesday, Wednesday, Thursday. Was completely exhausted for over those 3 days. So yeah, that was the highlight for me. And I know markets were not that great. I think there was a rally on Friday, but other than that, still going through that tough time. Dave, great. At least you're busy, not thinking about the market. I mean, I try to sneak in some time, yeah, during the offsite sessions. But again, it was only, you could sneak 15 minutes, 20 minutes during the lunchtime. Other than that, most of the time I was out from the market. Of course, on an evening, I try to catch up on the news, etc. But most of the time, I wasn't really uh, focused. Or you invite your friend Lalit. I see Lalit. Hi Lalit, how are you?
I'm well, thank you for having me.
Welcome, sir. Welcome. So this is your first time, so I hope you'll like here and will stick around. We've been doing this for almost 18 months, 20 months. It's been fun journey for me in trying to talk about markets, understand and share what I look into the markets, and also learn from all of you.
I heard much of you, and unfortunately, family and COVID had kept me away for a while. So I thought, let me jump in today and
Uh,
uh, connect and move forward with it. So greatly appreciate, and heard quite a bit about you. So quite interesting.
oh, I'm humbled. I hope you all what you heard was good about me. So let's see how it goes. But yeah, it's never too late. So welcome, Lalit. By now you would have figured out. I work in an IT company. So investment is my part-time passion, and that's what I focus on. This is what I want to do once I'm done with my regular job. All right. So yeah, that was the highlight for me for this week. So let's get into our regular discussion. What I want to tackle today was to talk a little more about portfolio protection strategies, because given the conditions in the market. Oh, no camera today. Oh, I missed that. Hold on. Okay, didn't realize that. I'm not a pretty sight to look at anyway. But okay, we can turn the camera on. That's not an issue. Hopefully, it won't interfere with the bandwidth. So there we go. Yeah. So given the what's happening in the market, I thought today I'll also mostly what I want to talk about is the market cycles, how it behaves, and what's happening in the market is nothing new, even though it might seem very difficult for us, but this is how the market behaves. And we look at some charts which demonstrate that, and then also look at how we stay invested, look at some portfolio protection strategies, portfolio protection moves, especially using options. And of course, we'll start our discussion with the macroeconomic factors. And if you have any questions, feel free to post in the chat or unmute yourself, and feel free to chime in. Anyone else did anything interesting or different which you would like to share? Any new stuff you done before we jump into our session for today?
Yeah, I haven't been here for a while, man. Looks like your participants went down, right? I used to come in, you have like 20 or 30 people in here, right?
Yeah, so participants goes down based on what's happening in the market. Unfortunately, I think everyone is interested in the market when the market is going up. So yeah,
I'm still a full-time day trader, so I still have we have Zoom sessions from 8:30 in the morning to 4:30 in the afternoon.
Okay.
These days I day trade Tesla at the money puts, at the money calls.
Okay.
Yeah.
Yeah. Yeah, unfortunately, day trading doesn't work for me, but I know, yeah, you're a day trader. And we used to have around sometimes 35, then move to 20s, mid 20s. And nowadays I'm seeing it's like mid teens. So by the time, we get into the session, generally we have around 16, 18, 20 people. So that's
I used to attend your session and then attend Kay's session Sundays, and I haven't been to Kay's sessions for a while. And somebody said, "Oh yeah, Kay's charging people for his sessions." I said, "Forget it then."
I don't know. So now I used to attend Kay's session, but almost in 2020, when he started talking about we should take HELOC and put money in the market, he lost me over there. I'm like, no, you haven't been in the markets enough. Market doesn't go that way, or doesn't always go up. And so I'm like, okay.
Hey, Vivek.
Yeah.
Can you repeat what you just said about Kai?
I mean, I used to attend this session. Again, he's a different type of, I mean, every investor is different, right? So might be on more aggressive side, but I remember him talking about how we should take HELOC mortgage and put everything in the market in 2020 when the market was just going up. So I'm like, I don't know if I subscribe to that kind of investment theory, depending on what's happening today in the market. So anyway, different people, different mindset, different way of staying investing or trading. And I have my own way, and I come and share with you. Some of you may like it, some of you may think too conservative, and may want to do something different. So yeah, pick up what works for you.
I always like your session better, man, because I think yours is more conservative, right? It's good for growing long term,
Yeah, I want to focus on long term. Markets go up and down in the short terms. Jay says, I lost zero money on Luna. That's positive. Same here. I will touch base a little bit on Luna. And unfortunately, on Thursday, I didn't have any of the crypto session. And because Luna had seen some tremendous growth in 2021. And I do know some of the folks whom I talked to attended, used to talk to me to understand more about other ecosystems, because they were completely 100% in Luna. And I was never able to understand the logic behind them maintaining the peg of USD versus Luna. So I said, until I understand that, I want to stay out, and glad that I stayed out. So Jay lost zero money on Luna, but that is actually a lesson in investing. So I do want to touch upon what happened on the crypto market. There was a whole big crash happened, triggered by uh, a deep pegging of something called a stable coin, which didn't turn out to be stable and crashed. Another crypto asset which was worth like $40 billion, 40 or $60 billion. So there's a big investing lesson over there as well. So we will talk about that. Yeah, so we'll look into market cycles. We'll look into some of the portfolio protection strategy using options. We'll talk about Luna. Jay's question is, some people say coin staking is just a big Ponzi scheme. What do you think? Now, depending on what type of a coin you're worrying, and how you're able to generate the revenue from that coin. So for example, now if your question was prompted by Luna, on Anchor protocol, which is where they had, which was based on Terra blockchain, if you stake USD, they were giving 19%. So that would, and now again, probably we are jumping ahead of our session, but why not? Let's go to, let me just talk about Luna and then I'll answer this question as well, right? So this is what I want to share for crypto update of this week. This is an interesting chart of a turkey. 1001 days in the life of a Thanksgiving turkey. The turkeys, keep feeding the turkey, happy, getting a lot of food, life is good until you arrive at a Thanksgiving day, and turkey doesn't know it's gonna, what's gonna happen on that last day, right? So this is a huge, we see these things in the markets as well, what we term as the tail risk events, right? Everything looks good until that tail risk events arise, and then depending on how someone is invested, you could either completely lose your portfolio or maybe makes escape unscathed because, hey, it was a small portion of your overall portfolio. So when we're building our portfolio, I think first thing which I always focus on, whether it's a crypto portfolio, stock portfolio, is how to survive in the market in case of tail risk events. Those tail risk events will occur unannounced, and the width of the tail risk or the fat tail risk, the drawdown on the tail risk could be way bigger than what you could have expected. We saw one tail risk event on March 2020 when the S&P within a few weeks fell down 35%. Now, because mostly I'm on the option seller side, my focus is on that these big drawdowns should not cause us margin calls, etc., and shouldn't cause indiscriminate selling of our assets. And we all survived that, right? No margin calls. Even now, over the last if in a growth stocks, now it's been about 15 months of a bear cycle, you're all still fine, right? No margin calls, nothing else. So protection against this tail risk event is the number one criteria. And this is what happened in crypto as well. This is the chart of Luna. Starting in almost a year ago, when it was close to few cents, went all the way up to $100 plus, and then just crashed, went back to zero. And I know a lot of discussions around here, including that volatile club, that people will, hey, Luna looks hot. I'm like, what's the logic behind it? Right? Not many people actually understood how the Luna ecosystem worked and how it looks hot. So maybe let's spend a few minutes so that next time, if you are evaluating any project, whether it is crypto project or any stock project, it's always important to go behind the chart go behind the stock price to understand why this is behaving. What does this damn thing do? What does this project do? Otherwise, you could be subject to such tail risk event. Now, coming to your question, Jay, coin staking just a big Ponzi scheme? In this case, in case of a Luna and the UST or Terra blockchain, it does look like. So now why am I saying this? In this Terra ecosystem, there were two assets that are most popular. One is the UST, which is termed as a stable coin, means it should stay its value at $1. Right? There are many other stable coins which are available in the market, which stay close to $1. So let me just bring up this thing. So if you look for UST, oops, let's go 3 months back. It was staying close to $1. Or a year ago, it will stay close to $1 because it's a stable coin. Now, the trick that they had was, how does it stay close to $1? Now, there are other coins, which is USDC, USDT. These assets are backed by something else which holds in value. For example, USDC is mostly backed by US dollars that are held in a bank account. USDT is backed by a combination of dollars, currencies, commercial paper, and bonds, etc. But they are in fact backed by something other than another crypto asset, right? Now coming to the UST, it was not backed. It was an algorithmic stable coin, and the balance of its value at $1 was driven by its relationship with another coin called Luna. Now, Luna is Bitcoin blockchain has a native asset called Bitcoin. Ethereum blockchain has a native asset called ETH. Cardano has a native asset called ADA. Polkadot has a native asset called DOT. Cosmos blockchain has a native asset called Atom. Similarly, Terra blockchain had a native asset called Luna. Now, if the validators, and again, I'm getting a little technical, so my apologies if you're not familiar with the ecosystem, but this question is important to go through it. What kind of games are being played in this ecosystem, and why you have to be really careful. So if you are a validator, or if you want to do anything on Terra blockchain, it's a proof of stake blockchain, means the validators need to hold Luna with them. They need to stake Luna so that then they can go and verify the transactions. So that is what drives the demand for Luna, is as a validators, you need to hold Luna so that then you can participate in validating the transactions and earn rewards. Now, how do you drive the demand for Luna? Is this relationship between UST and Luna. The way this Terra system blockchain claimed that UST will maintain its peg to $1 is by having a one-to-one relationship with UST and Luna. Means, say if Luna is being traded at $50, at any point of a time, you can redeem 50 UST for 1 Luna, or the other way around. You can sell your Luna and get 50 UST. Now, say if a UST goes down to 90 cents, for a reason, it depegs goes down to 90 cents. Now, arbitrageurs will come in because they can buy 50 USD, convert it to 1 Luna, which is being traded at a $50. So in fact, they will pay $45 to buy 50 USD and then convert it to Luna, which is being traded at a $50. So that will drive the demand of USD up. It means then the price of USD will start moving up from 90 cents to back to dollar. So this conversion between USD and Luna would bring in arbitragers who would then try to take advantage of any depegging or any inefficiency in the system and maintain the peg to a dollar. All these things works great, except when you have some kind of a tail risk event. And or when there are no arbitragers available in the market to maintain the peg. Now, so this foundation, the way why there was a demand for USD was there's an Anchor protocol on Terra blockchain. It was offering 19% return if you stake your USD with Anchor. And it exploded in demand. So who doesn't want to have 19%? I would like to have 19%, but I want to know how they are able to fund this 19%. Because on other blockchains or on other DeFi protocols, you get around 6%, 7%, 8%. I have staked some USDC to get 7% to 8% return. Because that's amount of return which you can generate through normal business activity in crypto environment. Getting 19%, it was because it was being funded as a marketing expense by Luna Foundation. So they were artificially creating a demand for USD by artificially giving or sponsoring the 19% return on investment if you stake your USD in Anchor protocol. That's how they were generating the demand for USD. Right? Now, the way this ecosystem works is if you want more USD, the ecosystem will create USD, burn Luna. Or if you want more Luna, they will generate Luna and burn USD. So generating artificially pumping up the demand for USD means to create more USD, they will burn Luna, so supply for Luna will come down, and we see, suddenly the Luna price starts to go up. Now, what happened in last few days? Because everything was risk off, we also saw risk of stuff happening in the crypto markets. And believe me, I don't think the people behind the Terra blockchain were naive. They had already started to take steps towards, getting rid of this peg and maybe back it by a Bitcoin. That is why the Luna Foundation was started to buy a lot of Bitcoin so that they could actually back their USD with something else than this Fugazi logic of, pegging with the help of arbitragers and all that stuff. But I think the day of reckoning came much sooner than what they had anticipated. Right? Now, during this tail risk event, we saw depegging happening. So people started to sell USD so that they could come out before the USD goes down to, I think from $1, it went down to 90 cents, 80 cents. People started selling it indiscriminately so that they can get out before it goes down to 50 cents. So what I mean, if you sell USD per protocol, you start creating more and more Luna. So suddenly there were a few trillion of Lunas got created, the price tanked to $0. Now, this is why it is very important, especially I would say, even in the stock market, also to understand what the business is of that company, not just depend on the chart. In crypto market, it is especially important that you study what the protocol is, how it generates money, what the project is about, how they are able to maintain the peg before you put in, I would say, a dime into any of these crypto projects. Did I feel bad while some of my friends were making money on Luna? And I'm like, I don't understand. I don't understand how they are able to maintain pack. Yeah, it was a pain to see people talking about Luna and how hard it is and what great it is. But some of these tail risk events, we never know when it will come. No one expected that we will have these consecutive drawdowns in the markets as we have seen now. But if 100% of your crypto investment was in Luna, that's bad. If you were invested 10%, fine, you still survive. So lesson is understand the project behind the chart, understand the business behind the chart, know why they were able to offer 19%, 20%. Anytime you have, there is no risk, no rewards without additional risk, plain and simple. There is no free lunch. If you are not able to understand the reward beyond what the general market offers, it means we haven't done our study well to figure out what the risk is, because there is no way you can offer above market returns without taking additional risk. So there was a risk over there. I don't know how many people who bought into Luna actually double click and try to dig, saying how are they able to function this, how are they able to provide this additional return, how are they able to maintain this peg. And this is not the first algorithmic stable coin that I've seen gone under. There were already two that we know, Iron Finance, and there was something else, were trying to do similar, some fuzzy logic of trying to maintain the peg. These things work fine as long as the world is, as long as the sailing is smooth. We only get to know the impact of it, impact of algorithms or impact of AI only when there is a tail risk events that happen. So, and we had that, and that's when kaput. Similar to this, I had my own reservations on Upstart. I still have it because that's based on AI, and all our computational logic work fine until there's a tail risk event. So if you've been talking about Upstart, and my philosophy has been, I want Upstart to go through one cycle of down round, one cycle of economic disturbance to see how well their AI logic works when they approve for a loan. If they are able to survive that well, great. We'll take some positions on Upstart. So I haven't touched Upstart. And I was glad that I stayed out from Upstart. So I'm always be cautious of all these words, AI, algorithmic, these are all new market buzzwords. We have to make sure that give them a time to go through one round of extremity to figure out whether these things really work or not. So I'm not saying every algorithmic stable coin will be like that, but this is the third one which I've seen has lost its value, and there are few that are still being developed. So again, the lesson here is double click, understand how they are able to, what's the logic behind them before you invest any dollars in that. 19% or 6% could be funded with new inflows from new investor. Once that stops, it collapses. One is that. The other thing is even the Luna Foundation, they were sponsoring a lot of that money to maintain that 19%. So I don't disagree. I'm not saying I agree that every staking is a Ponzi scheme, but in this case, I won't disagree that this was a Ponzi scheme, because you have a set of company or people who are actually owning this. Right? Now, immediately after this, this ecosystem collapsed, the founder of the ecosystem, the validators, they all shut down the any new transactions. Imagine if we are running and building projects on this ecosystem, and now your transactions won't go through it. Right? What a crap it is, right? So that is why when it comes to crypto, I'm really, really careful, pretty conservative on where I want to focus on, right? Very few projects that would, I want to look at and which pass my litmus test. Bitcoin is one, Ethereum is another one. You never see these things being shut down arbitrarily by a bunch of validators. So be careful. And this space, if you don't understand, it's okay to sit out. Right? No one is asking us to buy any of these assets. It's our own greed.
Vivek,
Yeah,
do you have any Solana or Ethereum?
I have Ethereum. I don't have Solana. I mean, let me be clear. I have maybe 1 or 2 Solana just to keep myself there, but I don't have any for that, any practical purposes. I don't hold any Solana.
Okay, thank
Ethereum,
you.
yes, I do have some Ethereum. I do hold some Bitcoins, some Ethereum. When I say some, means could be even fraction, because Bitcoin itself is like what, 30K, 35K. But those are the projects on which I have a little more faith than Solana or Lunas or Avalanches of the world. But I know a lot of these blockchain based projects are being pumped up and by VCs. And it's not the retail investors who lost money in this. Some of the well-known names like 3 Arrow Capital, Jump Crypto, they all had a lot of money in this, right?
Vivek, but isn't there more than one Ethereum? Like Ethereum 2, classic Ethereum?
So classic Ethereum has been was a project that has now almost dead. We can get into the details, but Ethereum got forked way back during its early time. And then the original one was named as Ethereum Classic. But most of the transactions and most of the network adopted the new Ethereum, which is now called Ethereum. So okay, so to the question, there's nothing much, no innovation happening on Ethereum Classic. So Ethereum Classic will be ETC. It might be somewhere down the line. I don't even see where that is. Yeah, there it is. Right. So these are still speculative, right? Not much of an innovation happening, not much of a projects going on this on this. So what I focus is on this one. A lot of development happening, a lot of projects being onboarded on this one, and we don't see all these artificial way of maintaining the value of the tokens. Now, if you look at a Terra blockchain, now the founder came back and say, hey, we're gonna do some stuff to increase the value of Luna. It means, hey guys, if you are, then it means it's like in the control of a few individuals. I don't want to be in that. Right? If you can stop the blockchain based on whenever you want to, can restart whenever you want to, now can think about putting a limit on how many Lunas can now be generated, and how you want to process transactions, then it's like I'm operating under you. I don't want to win this. Then Fed is better than depending, I would rather have more faith on Fed than having faith on some other individual. What a crap. And I'm sorry, it was a big black eye for the overall crypto ecosystem. This will bring in a lot more regulations because so-called stable coins is really not stable. It from $1, it fell down to 18 cents now. And it is going to bring a lot more regulatory eyes in this, saying we need to regulate this full ecosystem. But it is what it is. If we have a bad players in this individual, and on top of that bad players, investors put in money without knowing what they're getting into, and then they lose money, and then they start complaining about it. Regulators will come in. which I think maybe eventually turned out to be a good thing, because we need to get rid of these crappy projects anyway. Jay says, I asked myself, is this sustainable for years? If not, might lead to a rug pull. 95% of these projects will fail. And it's not just me saying it. And the funny part is that this is called karma. The founder and the main person behind this Terra blockchain, 8 days ago, in an interview, he was talking about same thing. 99% of the crypto projects will fail, and it will be fun to see them, or it will be entertaining to see them going down. Didn't realize that after 8 days, it will be his own project. But that's what karma is. Anyway, so we jumped the gun. We talked about the crypto. Life isn't good on the crypto side of the house. If you have investments in crypto, and I do have, so that's why I keep an eye on this. It's not been fun going through these drawdowns. But again, when I look at a crypto, I'm not looking for me. This is for the next generation, right? Otherwise, I don't want to win this. It will take decades to play this out. Or it could go to zero. So someone talks about, what's your thought on Bitcoin? I'm like, it could go to zero, or it could go to 300K or 400K or 500,000. There is equal probability of it happening. And if you cannot withstand this volatility or this thought that it could go down to zero, no need to be in this. No one is asking us. We are individual retail investors. We are answerable to no one but ourselves and our families. So don't tell me later on saying, I heard someone on CNBC and the Wall Street is out to get us. No, they didn't force you to press a sell or a buy button on your trading platform. It was you who took a decision, and we can decide to be in it or not to be in it, to be in a meme stock or not to be in a meme stock. And let's get away from the habit of playing a victim card. I don't like playing a victim card. And the only way you can get away from this, become more knowledgeable about what you're holding and why you're holding it, right? Rather than trying to blame someone else, blame Jim Cramer because he comes and pumps up the stocks, or blame XYZ on the YouTube, or blame me because I talk about some companies, or blame K because he talks about some companies. I think each one of us have to put on our big boy pants and take responsibility of our own actions. I talk about it based on what I feel. That doesn't mean you have to do the same actions. So yeah, we learn the lessons in the bear market. We learn lessons when some of these extreme events happen. And I hope a lot of investors in this crypto market would have learned lessons on what is important to look at the project and not flow with the wind. Doesn't always work out in this space. Anyway, so let's get back to the stock side of the house. A quick summary. Major indices endured another consecutive week of losses. Things are still going, a week in the overall market, 6th consecutive week of losses for S&P and NASDAQ, 7th week for Dow Jones, and this is the longest stretch of weekly losses for Dow Jones since 2001. Almost 20 years. In span of 20 years, it has never happened that we had such a big, consecutive week of losses for Dow Jones. Intra-week, in between some point of time during the week, S&P was down 18% from its peak, which is getting closer to the technical definition of bear market, which is 20% drawdown. So it was 18% down from its peak. This is an interesting chart looking at the weekly performance starting 2020. Like I said, this is the 7th consecutive week for sixth consecutive week for S&P 500. Even during the COVID lockdown and the COVID drop that we saw, drop was painful. Don't get me wrong, it was really painful. I mean, if you were invested in that, opening up your brokerage, logging into your brokerage firm's website wasn't a pretty sight to look at. But still, we never saw weekly losses, consecutive weekly losses even during that time. But this is what it is. And the reason is, market is worried about Fed's capability to achieve soft landing. And Jerome Powell came and admitted that they may not be able to provide a soft landing to our stock market jet, which is trying to land now. Soft landing means Fed will be able to raise the interest rate enough to tame the inflation, but not kill the economy and lead us into recession. 1970s, we didn't have soft landing. Paul Walker took a bold step to kill inflation, raise interest rates, but that also put our economy into recession. Now, if that happens, that's what markets are now worried about. So, risk off, sell everything, sell stocks, throw baby with the bathwater. I have nothing to do with any of the great companies. Sell crypto and move into safe assets. So we'll read about it in terms of what safe assets people are picking up. So 5 sentiments are still prevailing in the market. And I think week to week, maybe we should look at how these 5 sentiments are doing, because the reaction to these sentiments is what's driving the market. Fed's accelerated pace of money tightening. Not just not buying bonds, but reducing the balance sheet. That's what the tightening is. Moving from quantitative easing all the way to quantitative tightening. Persistently high inflation data. Even though the rate of the growth is now slowing down, but still the inflation is at much higher rate, than in the last 40 years. So worries about slowing growth. Disruptions caused by China's lockdown. And I think this and the inflation kind of are tied to each other. Our supply chain has been busted by these lockdowns, by factory shutdowns, by underinvestment in many areas of our economy. And now if you have to start investing, now it takes a few years, in some case, multi-year, for those factories to come back up, those oil wells to come back up. So those are the disruptions which are also leading to high inflation. And finally, the big macro factor is Russia, Ukraine. And now I think Russia, Finland, now they're threatening Finland that if you join NATO, won't be good. So 5 big sentiments that are now playing in the market. Depending on how market feel about on one particular day, you'll see stock market going up and down. Okay. So what happened on the inflation side? Right. So Wednesday, the inflation numbers was the most prevalent sentiment of all these 5. Right. Of course, it fell down a little bit. It rose only 8.3%, whereas the market was expecting that it will rise to just 8.1%. So it was higher than what market thought. But what could have worried the investors is gain in consumer prices for services, not just for goods, but for services. So now when it comes to services, it means these are the areas which are not constrained by the disruptions in the supply chain. I agree, auto sector, cars have become super expensive. We don't have chips. You order furniture on Scandinavian, they'll tell you come after 3 months. You ask any discounts? Absolutely no. Supply chain issue. But on services, Now we are seeing the surge happening in services, which will then have a broader impact across our economy. So we'll have to keep an eye on at services side, because even if the supply chain disruptions are taken care of, you can't roll back, let's say, the wages that you've given to workers. Interesting and a little scary. Airline fares jumped 19% over a month. That's been the largest increase on record. So Memorial Day, if you're planning to travel, make sure your pocket is thick with Benjamins. Whole lot of Benjamins. Airline travel is becoming more and more expensive. It's almost like 1/5 increase in the cost. And US Consumer Sentiment Survey, the most respected survey, is from University of Michigan. That hit its lowest level in 13 years. Again, US economy mostly driven by, it's a consumer economy. If consumers are not feeling great about the near future, they are not out there spending, they're not out there buying stuff, that's what drives most of our economy, not the exports. We are the net importer. We run trade deficits. And our economy is driven all by what me as a consumer consumes. And if we are not feeling the most confident about what might happen in economy for next 1 year, and we are postponing our purchases, or in some cases just canceling outright, then that's not great for for the companies. So these are the sentiments still continue to prevail in the market. But on Friday, we saw some bear market relief rally out of the blue. Now, how bad the things can go. Again, that doesn't mean the things became rosy. Even after the brief relief rally on Friday, we're still down on week-to-week basis. So at the end of a week, a major market indices, Dow Jones is now down 11.5% year to date. Look at the tech companies. They were taken to cleaners, almost down 25% year to date. And week on week basis, everything was down. So don't let the Friday event or the Friday jump feel us, completely optimistic. Overall, the situation for the week was still down. Right? From a sector perspective, like if you look at last 5 days, everything eventually ended up in red, except the consumer staples, 0.3%. That's largely driven by the increase in the prices, food prices. So they were able to eke out a little bit of a gain for the week, but overall, still red. So how are consumers adjusting to the new reality? I saw an article in Wall Street Journal, not going to go through whole, but now investors are looking at the world where stocks is no longer the king. And again, this is not what I think. This is what the Wall Street or their journalists or their analysts think. Right? And they have been wrong before. They could be wrong later on also. But it's good to look at different viewpoints and then frame our own opinion. Right? We don't want to be blindsided, or we don't want to be just stay in echo chamber. So what the thing in the markets is, of course, after financial crisis, if you wanted to get any return, you had to put hefty chunk in stock market because there was no alternative. It's a TINA effect. There is no alternative, TINA. So where do you go? Fed rates were zero. We're not paying anything. So only option was stock market. But recent times, Fed has turned the dynamic on its head. Dave, You are in my mind, man. Next topic was I bonds. Yes, I will talk about I bonds because at least 3 people reached out to me, not this week, but the week prior, talking about I bonds. So I thought I'll cover I bonds. So you're reading my mind, Dave. Yeah, so nowadays federal has turned that whole dynamic of no alternative over its head, because Fed has started to increase the interest rate, most aggressive since 1980s. Our expectation, investor expectation, is that by end of 2022, early 23, we'll have a 3%. It was 0 at 22. Now, if you can get 3% on Fed interest rate, and so far, whether like US government or not, this is still the most I would say the risk-free entity considered in the world, that US government, or the debt of US government. And if the risk-free return you can get is 3%, and S&P 500, their dividend is around 2.5%. I don't know what the S&P overall dividend yield is. Investors are starting to think, why do I need to take some risk on investing in stock market companies when I can get risk-free 3% return on from Fed? Right. So we did see some investors are moving money out of the stocks into ultra safe assets. And of course, the last few months of what has happened in the stock market, doesn't bode well, doesn't give a good news. It's scary for someone who's just trying to look for investment opportunities. Drawdowns of 60%, 40%. Overall index is now down 18% from its all-time high. So investors who are moving money out of stocks into safe assets like cash, bills, certificate deposit, money market funds. So then there are some numbers around, how many billions of dollars have moved into money market funds and all that stuff. And lastly, I bonds are making interest payments of 9.62%. Ooh, that looks interesting. 9.62 versus negative 14% on S&P for this year. And that's what it is. S&P 500 is what? No, negative 15%. Right? So no wonder I got on WhatsApp some message around, hey, how about I bonds? Right? So let's look at I bonds. So they gave us a perfect segue to talk about I bonds. I bonds right now are paying 9.62%. If we pick up the May I bonds, they are actually paying 9.62%. I took some notes on that. You can look at this whole terms and conditions. You can go to the page and go to treasurydirect.gov website. That's the only place where you can actually buy this. You can't buy it on your brokerage firm. It is taxable at federal level, but not at a state level. So whatever interest you will get, 9.62%, it is taxable, but only at a federal level, not at a state level. Minimum purchase is $50. You have to buy it at a website directly. You cannot buy it on Fidelity or Robinhood or any of the brokerage firm. You can buy it on treasurydirect.gov. But maximum purchase is $10,000 per SSN. So you can't buy more than $10,000. I'll come to it. There's a catch behind that. Now talk about interest rates. So right now it is 9.62%. Is this what you're going to get for next 30 years? No. So the duration for these treasury I bonds is 30 years. But this is not what you're going to get for 30 years. The way the interest rate is calculated is your coupon rate, which remains fixed, which is what you'll get for next 30 years, and which is currently at 0, plus inflation adjusted rate. Depending on how much the inflation is right now, they'll adjust the rates accordingly, right? Now, rather than reading through this, let me just show you this chart from the Treasury Gov website on how they calculate. So this is from May all the way to October. In November, they will recalculate it. So this inflation adjustment happens every 6 months. So the recent one happened in May, and then the next one will happen in November. So from May till October, if you buy I bonds, you will get 9.62%, and this is how they calculate. Fixed rate is 0. Semi-annual inflation rate is 4.21. Then they have a composite rate, which is a combined rate, is fixed rate twice into this plus fixed rate into semi-annual inflation rate, blah, blah, blah. At the end of the day, you end up into this calculation of 9.62%. Right? Not bad. If, in the stocks right now, 0% is good. Right now, the stocks are down, but I rather will focus on the long term. So what's the catch? One catch is definitely we looked at. It's a maximum purchase is 10,000. It is taxable at a federal level. A few more things I can come back to this chart later. Other thing you should look at it is when you say taxable, it is taxable at ordinary income level, not at a capital gains tax. So it will be taxed at a higher bracket percentage than your capital gains tax, depending on what tax bracket you are in, right? Now the interest is compounded twice a year, accrues for up to 30 years or until you cash the bond, right? You can cash it after 1 year. So you have to lock your investment for a year, but if you cash it before 5 years, you will lose 3 months of interest, right? Now, good thing is an I-bond earned interest for right from the first day of a month, even if you purchase it on the last day. So today is what, 14th. If you go and buy bonds today, you will get an interest for the full month of May. Okay. You cannot buy through brokerage or IRA. Now, earlier I talked about a limit of $10,000. You can buy up to additional $5,000 as a part of a refund of income tax. So means if you want, you can overpay your income tax through your W-4 adjustments, force a refund at the end of a year, and when you're filing your taxes, you can take an option of buying $5,000 worth of I bonds rather than getting the tax refund into your bank account. So using this trick, you could eventually buy up to $15,000 of I bond per SSN. So if you want to buy for yourself, your partner, your kids per SSN, you can buy $10,000 plus $5,000 if you use this roundabout with backdoor entry. Okay. So when you cash in, the gains are taxable at ordinary income tax. Now, if you don't want to report all the gains in one go when you cash in, you could choose to report the interest gain every year and pay taxes included in your tax returns. But if you do it once, you have to stick to the same method for next 30 years, right? Or until you completely cash out. Interest rates go negative, the principal is still secured. You won't lose the principal. So yeah, if you're completely risk averse, right now, I mean, because the inflation rate, the inflation is high, this 9.62% is not bad. But what surprised me was 9.60 is not now. Then if you look at the previously 2003, 2004, it's been paying more than 9.62 in recent times. 2019, it was 10.14%, right? In 2001, it was almost 13%. Again, depending on inflation and the Fed funds rate, they use that combination to determine what the composite rate would be. right? So that's around I bonds. Any questions? So let me see, read some comments. Dave says, I saw 100 of millions dark pool money went into QQQ, SPY, IW on Thursday afternoon. So in a short run, I'm hoping to get some short-term 100 to 300 points pump. And Steve said that he'll short the daylight out of it. Man, I don't know. I'm gonna just focus on my deltas, and we'll talk about that today. Dave says, I sold some bear put spreads on ES and NQ futures. I actually bought some stocks that were on my radar. So inflation fix will likely take 2 to 3 years. The 4th and 5th year interest will be down. So overall, 3 out of 5 years is not bad for I bonds. Yeah. And especially if you are, you don't want to lose any money for next 3 years. Maybe instead of holding cash, this may be a better option. Okay. Ramesh says, that means pay estimated tax interest rate till April 15, get a refund to invest in this, that to digital bond version later. Yeah, I don't know the mechanics of, I think, yeah, they will send you a paper bond. And I didn't read through the details of what the mechanics would be, but it is possible that when you opt to get a I bond, IRS will send you a paper bond and then figure out how to convert that to a digital one. But anyway, that's a quick note on I bonds. Crypto we already talked about. So what other? Yeah. Someone asked me, how was my week? Like I said, we had a company offsite this week. Pretty interesting to meet people in person, to meet the team. Most of the team, we had during COVID haven't. We always saw each other through the boxes in the Zoom, but it was great to meet someone in person. And I tried my hands on a new activity. This is me trying out golf. It's the first time in my life I held a golf club, and some of my colleagues were nice enough to teach me something. And then I was thinking about it today morning to do good in anything, whether it's investing or playing golf, same stuff applies, same principles apply. Dave says, what's that golf complex? This is in Milpitas in California. I mean, because I'm in Bay Area, so we had our offsite in Bay Area. This is called Top Golf. I don't know if they have a franchisees at other places also. So basically, it's a Top Golf, and I think they had 2 or 3 floors. And so from a company side, we had booked a few bays to play this. This can be expensive activity. Indeed, golf is not cheap. So what I was told, saying my colleagues told me to watch the ball when you're swinging and not try to look at, whether you want to hit the red one, green one, or those big circles over there. So focus on the action, not the outcome. Keep an eye on the ball. It took me a few swings to have the club hit the ball, because I was always trying to look front, and they said, no, don't look up, focus on the ball. Yeah, that's what we do in investing. Focus on the business, focus on the on the company's business, and not look at what it has done in recent time, right? If a business is good, it eventually we will get the returns. Number 2, consistency is the key. Okay. Hold it one way, position yourself in one way, and then stick to it. Especially if you are new, trying different numbers of clubs just didn't help. Pick one, stick to it. Stabilize yourself. Don't get perturbed by what someone else is doing. Lower your center of gravity. Know quick movements. It's just a nice swing from shoulder, and that's what we need to do, and zone out. Right? This is very important. Zone out. There are players who you will see who've been playing golf for years, kind of hitting the numbers on the board. Forget about them. You are just starting off. Just focus on what you want to do. Right. Similarly, in the market, just zone out of all the news, whether positive or negative. Focus on what you hold. Focus on what your outlook is, what you want to get out of that investment. If your motive of investing is comfortable retirement, excuse me, which is 15 years down the line, why do you care what happened in the market in the last 6 months? But if your focus is, I want to sponsor my trip to Hawaii, which I have to take next year, then yes, you have to care about what's happening in the market. So I learned some, don't know what stuck in my throat, sorry. So I learned some lessons from golf. So they say, so relating investment, what's your S&P SPY and QQQ targets? I have none. Really, I don't know where the SPY will go. Right? I've heard it could go down to 320. That's what again, I've heard analysts come and talk about it. It could go down to 320. But yesterday, another analyst came and told from Yarden saying, hey, he sees that it should go up. Who you believe? I have no idea. Again, my focus is, Dave, and to look at how much delta I'm holding in my portfolio and reduce the delta if I want to be a little conservative or try to reduce the impact of the market if the market continues to go down. Okay. Just so that I don't get scared out of a market and sell my shares. And right now, I'm also looking at opportunities to start opening up positions in the shares that I wanted to own, but didn't own it for last 2 years. Right? I talked about it last week. I bought some Shopify at 400. Was that the best decision? Probably not, because it fell down to 300. But I don't have that crystal ball. So I will okay, pick something up. If it falls down more, oh, it came back up more than 400. Okay. So that in any case doesn't really matter. Okay. So again, but my goal is I don't need this money for next 5 years. If I needed the money for next few years, I would behave differently. But I am collecting, I am adding more capital this year. I didn't add any capital into the markets last year. Mostly it was, didn't add much, brought in much cash into investment because market was super high. I didn't sell my stocks, but I didn't add additional capital. But this year, I have been adding additional capital into the market, bringing in more cash, which I had kept on the side, adding that into the market. But I think I started it too soon. I started in February, but yeah, who knows? So I don't have any targets for it. But one thing I know is maybe 10 years down the line, the great companies which I want to hold will become better businesses and the stock price will take care of itself. All right, few more charts. Drawdowns that we are seeing today is just normal. Doesn't feel like that it is normal though, right? It's painful. How can this pain be a normal thing? But if you look at S&P drawdown since 1928, 44%, 20%, 56% in 2000, 2009. And if you live through this, the current situation won't scare you. Right? So unfortunately, there are many investors who came into the markets in 2020 haven't lived through these pain, right? And now getting scared out of market. Like, okay, let's sell, let's move into cash. But right now, what S&P is down 18%. No, not even 8. Yeah, overall, from the all-time high, it's down 18%, right? Pretty normal. I know it's 18% is, I think, right now the least. Yeah, we've seen drawdowns like during Great Depression is 80%. Even if you don't go that far behind, 20%, 30% is pretty normal. So what we are witnessing in the market right now is very normal. Nothing unusual. But even after that, this is how the markets have behaved over the last 200 years. Right, starting from 1797, right? We have had Great Depressions here, Spanish-American War, stagflations, Mexican War, War of 1812, Vietnam War. What have we not seen? Right? Global financial crisis. When we are in the moment, the things feel very painful. You just zone out and look at what's has happened in the past. Is nothing different than what's happening right now. Right? So, more recent times, Vietnam War, US bombing in Libya, right? Iraq War, long-term capital management collapse, Y2K, recession, 9/11, all these, go back to those headlines on these days or listen to any analysts. Yeah, we should sell off the stocks. Stocks are no longer loved during any of these sessions, right? But what does S&P 500 continuously do? It has its ups and downs, but extend your time period and still has done pretty nice. So last 6 months, I think it peaked in November, right? So last 6 months is nothing as compared to what we have seen over these years, right? And all of these sound to be very, very intelligent reasons of why not to hold stocks, right? Markets fell 22% in one day in 1987. Who in a right mind would advise anyone that we should be invested in stocks if it can fall 22%? Right? But eventually, if you look at overall return perspective, stocks, bonds, bills, gold, dollar, from 1800s, stocks have still been the best investment ever. Of course, it has gone through this 22% drawdown, 35% drawdown in March, and now 18% drawdown. But despite all that, stocks are still great, right?
Vivek,
Yeah.
we invest in companies. We don't invest in the S&P 500. So
No reason why you should not. Invest in companies only if you understand about companies. If you don't understand about companies, I would rather say invest only in ETFs. That's a
let me give you an ETF that my mom told my sister, which is, I think, is very good. USD. It's on semiconductors.
That's right. Right.
USD.
Again, so when you're starting investing journey, right, it depends on. So before I went into individual stocks, and I only started looking at individual stocks in around 6-7 years ago in US, right? because, hey, I was new to US market, didn't understand much about how the markets behave. I was all in 7 ETFs. I had 7 ETFs every month, just deposit on those 7 ETFs, because I did not have time to look at what Google does, what Facebook does, how the US companies behave, until I got myself to a level where I could understand the business. Or, then I started investing and picking the individual stocks. So important is to, if you don't have time or energy to follow individual companies, stick to ETF. And all those, what we are saying is it's an ETF results, right? So S&P 500 kind of attracts how the overall US economy is doing. Individual stocks could be 10 times more return than S&P or 10 times less return than S&P. That depends on each of the company. So if you're investing in individual company, you're subject to the company risk. If you're picking up a specific sector in S&P, you are subject to that sector risk, if that sector is hot or not. Oil sector has not been hot for last 15 years or 12 years. It was a hot sector in 1970s, not hot anymore. Probably now is becoming a hot sector right now. But if you cannot go through these cycles in any particular sector, pick up whole S&P, which is cut across sector. If oil is not performing, something else is performing. Tech is performing. And now tech is not performing, but the commodity is performing, energy is performing. So you will balance out these if you pick up the overall S&P, right? I think Vanguard has got VTI or something, Vanguard Total Index. Use that. That's for a retail investor, rather than trying to follow Jim Cramer's of the world or Reddit's or I don't know, whatever crap on YouTube. Unless you build your own conviction or a time to study individual stock, ETF, again, my perspective, is still the best way to go. Rather than trying to take a risk that you don't understand. Because what happens if you don't understand it? If you don't understand why you got into it, you'll be the first one to jump the ship when you see some cracks start to develop. While if you understand why you got into it and you see there's no change in business, that actually might be an opportunity to buy more and not sell out. So staying with an ETF, absolutely no issues. So because this is mostly when we talk about US stock market, most of the studies are around overall market, which is S&P 500. Right now, this someone asked me, right, what's my target for QQQ SPY? I don't have any target because I'm looking at next 10 years of holding period, and your odds are positive return if your holding period is longer, starts to continue go higher and higher. Okay. There has never been a 20-year period when the market has lost if you continuously invest in it. Of course, if my holding period is only 1 year and I started investing in 2020 end, I am down by a lot, because that's what the 30% of the time when market doesn't work, I'm in this stage right now if I started investing in 2020. But if you've been investing in since 2000, continuously investing, I'm pretty sure your overall portfolio is still way up. So that is why I want to focus on, when I look at a company, I want to look at a company, do I want to hold it for minimum 5 years? Okay. And then see, how do we build positions in that? So this is I find this pretty fascinating and interesting chart. Is right now it looks like everything is so bad, don't want to be in a stocks. It all depends on how long, when do I need this investment to work out? And if you recall our 2020 discussion, my idea was, if you want to get in for next 5 years, only then stay in the market. Take that money out, which you need in less than 5 years or 3 years. This is the reason why. But this is a price we pay. Steve, I'll come to the NASDAQ also. I see your comment. But this is the price that we pay for these returns. S&P from 2000 till May 2013 has not returned anything. Means if you invested in 2000, September 2000, and you just did a lump sum investment and held on to it, till 2013, you are just back to where you were. And of course, it is adjusted for inflation and dividends. So there have been periods when the market had zero returns. 13 years, zero returns. 1973 to 84, 12 years of zero returns. You must be wondering, what am I supposed to do here? Markets are not performing. But if you have been continuously investing, let's say when the markets went down in September, started to recover, the picture will be very different. But we're just talking about a lump sum investment. Similarly, Steve says, not quite. NASDAQ peaked at Y2K, 5,000, took 17 years to get back at 5,000. So that may be on NASDAQ, even S&P took 13 years to get back. But this is, if you just did investment on NASDAQ on the peak, didn't add anything more, right? That's why I want to focus on continuously add to it while it is going. If it has gone down and while even it is coming back up, then the numbers will look different. Then you will be breaking even much sooner than the 17 years. Now, on top of it, now because we understand options, we have a way to continuously reduce the cost basis while market is not doing anything. So with these, so much of tools at our end, I don't feel like why I should get out of market. So another chart around cycle of market emotions. Optimism, excitement, thrill, euphoria, we had in 2020, anxiety, denial. I think now we are out of denial. We are in fear, I would say fear and desperation. Capitulation, I don't know. I mean, we are down, what, 18% year to date. Not year to date 18%, 18% from all-time high, which is not even a bear market. So I don't think we have had capitulation yet. But, these are the areas where there is a desperation, capitulation, despondency, depression are the areas where the most money is made. If you stayed investing in this and right back up, and this will always happen every time during these crises, we thought we'll never recover. It's a human ingenuity, right? We will always recover. That's the difference between humans and animals, is we figure out a ways to recover and survive and become better year after year. Centuries after centuries, we become better and better. So, sure, last 18 months haven't been great. Last 15 months haven't been great, but this thing will turn. And then I don't want to be caught in a way where the market is coming back up and then like, I'm sorry, I'm not invested. I never had. Right? So how do we make it easier for ourselves? I'll come to that. I see a question. If Russia ever launches nuclear missile attack on Ukraine, what levels of drop do you think will happen? I don't have a crystal ball, but I think we again, the guess is we would see an enormous drop. Could be 30%, 40%, 50%. Right? that's what you call as a your Mayday scenario. And worrying about what's happening in the stock market will be least of our worries. If we actually end up into World War III and full armed nuclear world war, then what's happening in the stock market will be least of my worries. So, but that will be a doomsday scenario. And at that point of a time, like I said, yeah, it will be you. Yeah, I understand. Ukraine doesn't have anything. It'll all run being supported on the back end by NATO. The idea is if NATO gets involved, that's going to be a doomsday scenario. Or if we just let Russia do what it does in the name of, hey, let's contain it, let's not let it escalate, probably not. But if it becomes a full-fledged third world war, the stock market will be the least of our worries. Steve says it's true. If you kept adding during 17 years, you recover much faster. How many people would do that instead of bailing out? That's exactly a point. The whole idea is, and now I am trying to learn and probably want to share is, how do we stay invested? What are the things that we can do which will help us staying invested, not bailing out? So how do we make it easier? So personally, I make it easier, number one, by being conservative on personal finance side, which means no debt. Because hey, if you don't have debts to pay right now, I don't have to really generate huge cash flow right now to survive. I have no debts to pay except my mortgage. Don't overstretch your finances. Buy or spend only what you can afford. Don't spend your future income today. Keep your savings rate high. Have multiple sources of income, or essentially in a way to say, try to find out ways to increase your income. Don't compare yourself with your neighbors. Neighbors driving fancy cars, live in bigger house. That's okay. You don't have to stretch yourself. Be conservative on your personal finance side. At least 6 months of living cash expense in hard cash. I have a little more than that. And I know inflation is 9%, whatever 8%, which I'm losing, but this is the money sitting in CD. But that allows me to become little, stay invested in the market, then I would do it. And lastly, I don't want to finance short-term expenses through long-term investments. And as I say short-term expenses means, hey, my kids' college is coming up next 2 years. I don't want to depend on stock market for that. So my generally outlook is 3 to 5 years. If I need something in big expense in next 3 years, say we want to buy a new car in 3 years, I'll have to move that money out today into a different, more cash or cash equivalent, and not keep it in the stock market, because I don't know what could happen in next 3 years. Right? If that's an expense that I have to do, it is mandatory. It's a short-term expense. This is what WeWork was doing, right? If you recall correctly, they had their business model inverted. They got themselves onto the long-term expense and was financing it through a short-term income. Right? Same way, or you shouldn't do either way around. WeWork got into long-term leases of 15 or 20 years. That was a long-term expense because they were contractually obligated to it, and were financing it through renting out spaces to startups for 6 months, for a month, and you don't know how long the startup will survive. So when I looked at when we looked at WeWork, I feel, what the heck are they doing? And eventually, market figured it out. Irrespective of whatever Goldman, or I don't know who the investment bankers were, They were talking about $40 billion worth of that company with such an inverted business model. So same thing apply for our personal finance. Be conservative, and then you can hold stay invested in stock market. I still hold a lot of growth stocks. I have investment in crypto. Focus is continuously reduce the risk, which is what we're going to also talk about, is portfolio protection and dry powder to take advantage of opportunities. Right now, the biggest pie, the biggest slice in the pizza is cash. Been holding cash. Now it's the time so that I can take some advantage of these opportunities which come along. Right? Am I gonna go all in next week, deploy all that cash? Absolutely not. Right? Because even though where the market is right now, I don't have a crystal ball to see it won't go down further. Right? So, but now it's a time where I want to take some opportunities on some good companies, which are default alive companies, and stay away from the default dead companies. The companies that always need a ventilator to support, those are the companies maybe in these times, maybe I'll stay away from them or reduce my exposure to it. And the companies that have been spewing cash, but have been beaten in the market, maybe I'll increase exposure to that company. But I can only do those things if I have a dry powder available. So always keep dry powder available in the market. Doesn't matter how interesting an opportunity looks like. You never know what's going to happen to any stock. Another interesting chart. What drives the stock price? Right. This is from Bank of America. First year when the company comes to IPO, 46% of its valuation is driven by the multiple. Right? What's happening in the market generally? What market investors, what multiple valuation are market investors ready to give to a tech company? In 2020, those multiples were for a high growth tech company. Those were 40 times the sales. In some cases, like 60 times the sales. When a company is unproven because they are new in the market, most of their valuation is driven by the multiple. As the company stays in the business, continue to prove themselves in a long term, it's the sales and the profits that drive 90% of the stock price. Right? And less and less impacted by the multiples. So that is why it is important to focus on the business, because sales and profits are all with the business. Right? How is company doing from a revenue perspective? Are they making operating income or not? Are they cash flow positive or not? Because in the long term, that works out. So yeah, 2020 enjoyed great multiples on a lot of companies. And those companies now no longer working out because they didn't have the business side of it. Anyway, these were some of the best stocks in the last 20 years. Amazon, Netflix, Tesla, Apple. Right? But these were the drawdowns that happened on those stocks as well. It's earlier there was a question on, we invest in individual stocks. Yes, if you invest in individual stocks, these are the drawdowns you have to go through to get to the to enjoy the fruits of those winning over last 20 years. And like Steve said, how many of the investors would have had the balls to stay in the market and hold on to the good business if it was down 60% or 85%? Amazon, at some part of a time, Amazon was down 92%. Apple was down 85%. Because the worst part is that the stocks that have actually gone to zero have done the same thing. Stock has decreased 70%. Now you don't know, is that going to go down? Is that going to go down by another 70% because it's a bad business? Or it is a good business, but the stock has been broken down because of multiples have contracted, right? So over long period, if the business continue to do good, the stock will eventually catch up, right? So real time, it's almost impossible to know if we are sitting on a rocket, which is now available cheaply, or we are on a sinking boat. Only way to figure that out is go back to the basics, look at the business, and not on the price. Price has fallen down 80%, doesn't mean it cannot fall down another 80%. But so time is to focus on business. If it is a bad business and hence it is a bad stock, cut it out from your portfolio. But it's a good business, but the stock has become bad because of the market conditions, might even take that as an opportunity. It's the same situation. Stocks are down 80%. Depending on how much you know about the company, you may have to take two separate actions. So in this drawdown, I'm still here. And believe me, portfolio right now, based on where it was in November, doesn't look good at all. That's okay. I understand, I don't need that money tomorrow or for next 3 years. But it gives an opportunity to cut down the companies that were more speculative in nature, or that I got into because maybe, these Reddit people will pump it up. Time to cut those down and focus on the good companies. Okay. Another interesting chart are the whole drawdowns of S&P since 1929 and overall returns, right? It is more expensive to miss out the bull market than to hold through the bear market. So I do hear, people talking about, let's cash now, and then we'll get back into when the markets, become favorable, which I don't know how will market become favorable, but they don't tell you. And it is more expensive to miss this than holding through the bear market. But you can hold through the bear market if your overall finances, are in a good shape in terms of, the way you're invested and the way your outlook is. Bear market feel more intense, more vicious, but they don't last too long. I mean, these are the numbers. It is not made up numbers, right? These is what the history always tells. And every time in these point of histories, we would have gone back and said, no. This time is going to be different. It's okay. It didn't last in the last decades, but this time it's going to be different. Humans always think we are always trying to, what's called your risk. I'm always amplify the risk. That's why option sellers make money, because humans, as a human being, we are always amplify the risk. Overall, in the long term, S&P 500, despite all that we have seen, if you had invested $1 in S&P 500, 1871, all the way to 20, it had all those up downs, all those 20% drawdowns, 40% drawdowns, 60% drawdowns, all included in this. All included in this. So why do I care? Why would I wait on the sidelines saying, okay, I'll cash out and wait for market to bottom? Are we waiting for market? Are we trying to look through the news and see, is the news getting any better? Are we waiting for someone in the market to ring a bell to tell that, hey, I bottomed out. Now I'm bottomed out. The market will never tell us when it has bottomed out. I don't know, even if you go, I think in 2009, market bottomed out on March. Go back and look at the news archive. What was the news at that time? I bet your news was even worse, all doom and gloom. So if you depend on what analysts have to say, if you depend on what what you know, the news has to talk about, the economic outlook, etc., we'll never get those signals. We'll never know when the market start to move in the opposite direction. So don't try to guess it. We'll never get a ring. So how do we stay invested and how to reduce the risk in a portfolio so that it becomes easier on us? Because one thing I've realized is there is no point in trying to get out of a market if you're holding good companies. Now, how do we make it easier for us to stay through the market while all this crap is going around? While you see NASDAQ going down 5% on some days, 2%, not 2% has become a norm. At 2% down has become norm. How do we stay invested in the market? What else can we do? That's brought me to the options, and we'll look at some of the ways to reduce the risk around a hedging the portfolio. So we'll talk about it. Let me sip some coconut water and read through some comments. So the smaller companies like Palantir, AI, Coupang, Jumia, Affirm, Peloton will have a smaller balance sheet. Can likely go out of business. Good target to short the heck out of them. Oh, I don't know what you, from a balance sheet perspective, we'll have to, so again, when I look at these companies, I'll first want to look at, are they generating operating income or not? Right. If they're able to generate an operating income, means they're able to feed themselves. So today, why the wind has been knocked out of a lot of these companies is they were on ventilators. They always needed a Fed ventilator, essentially a way to raise money at a cheap level, at a $0, 0% rate, or maybe the minimum percent rate to run their business, because their business was not enough to sustain itself. So I want to look at, first of all, I look at, okay, how many companies are able to make operating income? If a company has positive operating income, in my eyes, it is, okay, let me put the other way around. If a company does not have a positive operating income, it means it is default dead. Default dead.
Operating really is just your expenses, right? So now we're not even talking about revenue. We're really just talking about whether or not they're making enough to cover the expenses, right?
So I'm talking about operating income means revenue minus operating expenses, not the net income.
So then likely Palantir and AI might be fine, right? Because they have government contracts, right?
They have a government contract. The question is, how much are they spending? If their revenue is $100 million and they are spending $150 million to earn that revenue, how long can they sustain? In previous years, they were able to sustain because they raised a lot of capital, right? So then the next step I look at when I'm looking at any companies, okay, if it is not operating income positive, if it is operating negative, how are they going to fund that operations? Do they have a strong balance sheet? If they don't have a strong balance sheet, it means then they'll have to come back and raise money from the market. IPO market currently is not favorable, so they'll have to raise money through debt, or now the cost of raising money has become expensive. And that is why a lot of the companies who were dependent on, external help because they were not profitable are now being knocked off in the markets. So, but if it is making operating income positive, then I'll still be okay. It means at least they know how to generate enough income to run their business, their operations.
So another extreme example right here will be kind of like Melly, right? I think you were a holder of Melly, right?
Melly is my biggest position.
Yeah. So now they are down at least a half, right? From the highs of 2000, right?
Oh yeah. Oh yeah, it has been cut in half
So the
because it
question
doesn't
then,
generate any net income right now. But they, from operations perspective, they're still doing good.
I see. Okay.
Yeah.
Thank you.
So yeah, so they don't generate any net income right now. And net income, so again, right, many of the growth companies will not generate net income because they want to fund back, they'll, let's say if I'm a growing, and I got $100 million worth of sales, and my sales and marketing expense, my expenses of my salaries, my labor, etc., is 80 million. So I spent on 80 million. Now I have a 20 million operating income. Now, if I'm a growth company, if I want to grow my business, I would rather put that 20% in adding more machines into my factory. Now I'm talking about, let's say, manufacturing company. So I'd rather use that to increase my production capacity, but that means my net income is going to be zero or might turn out to be negative. But that's a conscious decision I am making as a CEO of my company, saying I want to invest in growing my business, because I understand short term it is a pain. I will not be able to offer any dividends because whatever operating income I had, I put back into setting up a new plant. But that setting up a new plant will help me 5 years down the line. So I can still look at and that and say, I think I'm okay with this company. It might have a short-term volatility right now because it doesn't generate any dividend, doesn't have any free cash flow, doesn't have any net profit, but they're investing for future income. And if my outlook is that 5 years, 10 years down the line, it will pay off, then I'll be okay to hold it. But if it is,
yeah, this is good. Yeah, I'm more of a technical analysis right here. It's good to learn fundamentals from you. So in regards to the fundamental side, right? So the next quarter, I think everybody's expecting to do fairly bad, right? If we were to look into the fundamentals, how many quarters should we be looking at from a balance sheet perspective to say, hey, the company is not doing well?
So I don't know if we can generalize on each company. For example, let's talk about, let's say, Upstart, right? Yeah. Upstart, not Upstart. There's a Unity. Unity fell down 40% after announcing their results, and I hold Unity in my portfolio. But I only got, I was driving on my way to office, and I was listening, and then I realized, okay, Unity fell down 40% after their earnings announcement. Now, the reason why Unity fell down 40% was they had to take $100 million worth of a charge or less revenue because let me take a step back. So Unity has a tool called active pointer tool, which allows them, tells the software where to place ads in the games, which will be effective for the advertisers. Now that tool has been trained on machine learning models using all the data that they have collected through all their customers. Now this quarter, Unity came and admitted, saying they had a bad data from one of their big customer, and that screwed up their machine learning model. And hence we were not able to place the ads at the right place. And hence we were not able to generate a revenue that what we thought we will be able to. And they had to take $100 million worth of a chargeback, or I would say $100 million worth of less revenue because of this particular issue. And then they said, because now we have to retrain our model, and that takes time, because to retrain the model, you need to now, first of all, clean up your data that you use to retrain your software model. And then you have to have enough data for it to retrain itself. It will take us, I think, two or three quarters is what they mentioned. And then they reduced their guidance based on this issue. Stock fell down 40%. Now, if you don't know about why the stock fell down by 40%, you might be looking at the chart and say, oh, it's down, it's below my moving averages, depending on if you will focus on bear cross or whatever, more. I'm not that technical analyst, but there are, bear death cross. If the stock has gone through a death cross, we want to sell off. But if you know about what has happened to the rest of the business, which is their creator side, that has grown gangbusters, 65% year over year. But this one area of business, which is on their operating side, operator business, has a lesser revenue, got impacted because of this machine learning model that has gone kaput. It will take them at least 2 to 3 quarters to retrain their models, and then before we start seeing the impact of it. Now, in this case, yeah, I would want to give Unity at least till end of this year, or maybe first quarter of 2024, to see what they're doing in their revenue and how their operate solution has behaved. Because the problem lies in this.
Very good insight.
Company has identified it, which is good. They're not trying to push it under the under the table, say, oh, everything is good. They came back and no, this is the issue. We figured it out. We need some time to fix it. Yeah. Now, some hedge funds who were looking for a bump may not have that 4 quarters of outlook, might want to sell it off. We saw 40% drop in it.
Yeah.
Right. So for them, yeah, I'll give them 3 quarters, 3-4 quarters, and wait for them.
Okay. Thank you.
So that's what I would say. There's a one answer to it, depending on what the management tells. I would rather give some faith, have some faith on management, and give them that much time. And now, if that time doesn't gel with my investment outlook, gosh, I need money in next 2 quarters, then I'll sell my Unity. Scrape off, salvage whatever is remaining, because I have that expense coming up 3 months down the line, for which I had invested in Unity, which means go back to the first one. Don't invest anything if I need it for next 3 to 5 years, plain and simple. So I have Unity. I'm still holding on to it. And right now, I think I have a short put at it. No, I think I had a put spread, which is now way in the money. So probably I will buy some stocks at this point of time. Samuel said the company has a strong balance sheet and is well positioned to invest in growth. Is Palantir a good investment 2022? Oh, that was about Palantir. Palantir is a very enigmatic company when it comes to their products. So, but yeah, I'm bullish on Palantir long term. So focus is, how do I stay invested and reduce the risk in my portfolio? So I want to quickly go through one of sessions that we have done, and I think it will take much longer time. You will need at least 1 hour. So maybe we'll do that for later next week. Is portfolio risk reduction strategies. But I can give you an outline of what I want to talk about. What I thought I will talk about and cover today, but that's something that we have covered in earlier when I had a time to do option boot camp. It used to be one of our last sessions where we look at an overall portfolio management, portfolio risk reduction. So looked at buying puts, selling calls, call spread, collars, ratio spread, reducing deltas, portfolio beta weighted deltas. So yeah, it will need at least, looks like 90 minutes. So apologies, not going to cover it today, but I will talk about it in our next meeting on portfolio risk reduction. Meanwhile, if anyone have a question on that, feel free to ask me anything generally around option, if you have any question. So what am I doing nowadays? Of course, staying invested in stock and using indices like QQQ, SPY, and selling calls on this to reduce some impact of this downturn. Right. So when you sell a call, on, let's say S&P or QQQ, you outright you get some premium, but that means if QQQ goes higher, means the overall market has gone, the tech sector has gone higher, you will lose on option, but your overall portfolio will look good, right? So that's what I've been focused on, is to reduce overall, use S&P and sell calls against S&P or sell calls against QQQ to reduce the deltas in portfolio. Now at an individual stock level also, if I am holding 100 shares, I might sell a covered call, at way higher, let's say 20-30% higher price where the stock currently is, and do it continuously. I mean, I still hold Melly, Dave, like I said, yeah, I hold Mercado Libre in my portfolio, but I've been reducing the cost basis for this continuous. I still hold Jumia in my portfolio, and Jumia is the.
And that's one thing you're still believing in Jumia, right?
Sorry.
You still a firm believer of Jumia, right?
Yeah, I still am. I mean, and watch it quarter after quarter. I had, so let me just share how and it's not that I always had one outlook towards Jumia. Depending on how the business has behaved, I have also, let's go to.
Which means you also probably have a coupon, right? Which is the South.
I do.
South Korea, Amazon, whatever.
Yes, I do. But that's like 20 years. It will need 20 years to play out. Just still building the delivery infrastructure, man. I mean, US had FedEx, USPS. They don't have that. So that's what Coupon is building right now. So Coupon is like 20 years of outlook, right? So Jumia I've been holding. And has my sentiment changed? Yeah, I moved from being unaware of it to a little bullish to neutral to slightly bearish, and neutral to slightly bullish in the previous quarter. And the stock has gone at all the places, right? $14 to $9 to $25. It has gone to $60, 18. And the most recent, when I analyze its earnings, is on Q4 2021. Yeah, I look at what I find good, what I find not good. And then I say, what am I supposed to do with it?
Yeah.
At no point of a time, I actually went into mode where I say, I need to sell it right now. So again, I was slightly neutral to slight. Yeah, here was a slightly bearish. I'm selling now null delta covered call, null delta strangle. By cost basis.
Are you selling weekly cover calls or monthly cover calls?
Around mostly monthly. So on November, my cost base was 17, and I continue to sell my calls. Now my cost basis is $15 some. Right? My cost of buying the shares is 34. So from 34, right now the stock is at what, 6, 7, but I already reduced my cost by 1/2 of it, right? So I don't see the big crack in the business, which will cause me right now to just get out of the stock. The day I see that, if I don't have a faith in a business, yeah, that's the time when I'll sell, at the money call, just try to get out of it. But that's why I'm still holding it. Market doesn't like it, but I still don't see any issue big on the business side.
The other day is kind of strange. I was looking to the logistics stocks and also transportation, like for example, UPS and FedEx, they're down. But all the railroads that were up, I was like, I couldn't figure out why.
Yeah, I haven't looked at the railroads. I've never looked at that sector, so I won't have any information.
Because I mean, that's also an indicator to me whether or not the retail is doing well, right? You look into the logistics side of things, right? So
yeah, so I think the overall the more e-commerce is a big tailwind behind logistics anyway. Now the issues which will win in that logistics business is a bigger question, depending on Again, that's always a problem, not a problem, but that's always a risk in investing in individual companies. If Amazon comes up with their own, Amazon, when they announce their own fleet, UPS and FedEx, they all puked. But I think e-commerce is a tailwind behind the logistics business anyway. What is this? Okay, Ramesh has some yes, so it becomes covered call in case of assignment. What if I don't do is a question. Okay, is it a good idea to sell call against the short put? If you are, is it a good idea to sell a call against short put? For a new retail investor, new to options, it is not a good idea. Number one. Number two, if it is a volatile stock and if you don't hold shares, it is not a good idea at all. Now, would I do it? Yeah, because I've been doing options for many years. I know how to manage it. I would still not sell it in a stock like AI or Palantir, which become very volatile, because I don't want to get caught naked on the call side on these such volatile stocks. Will I do it against Microsoft? Anytime. Will I do it against S&P 500 ETF? Sell a call against a short put? Always. Because those don't jump 15%, 20% in a day. But I would say doing it on growth volatile stocks, I won't do it. It might work 80% of the time, 90% of the time, 10% when it won't work, it'll really hurt you bad. This could become a, picking pennies in front of steamroller, and I don't want to do that. Yeah. So Steve say, yeah, you short the put first, then sell call if it gets a sun. Yeah, convert into covered call. What I could do is, if I have a short put, I'm okay to sell a call spread. Just contain the risk. So remember, again, the tail risk. Whenever we are investing, we always forget about the tail risk. And the problem with these smaller cap and this volatile stock is, what if Amazon comes and say, or Microsoft comes and say, we're buying Palantir, 3x the current value. We just screwed if I had a naked call on Palantir. It won't hurt much to maybe buy or sell a $5 wide call spread on Palantir. You might lose 5 cents in the premium, not Peloton, but Palantir. But if you might lose 5 cents in a premium, but it will save your back when it in case of a tail risk event. That's what we need to worry about. Can there be a tail risk event on a company like Microsoft or Apple? Not until we get into this Ukraine and nuclear war situation. These are the big companies, don't move 10%, 15%, or 20%. So be careful about the tail risk events, and let 5 cents go and give you protection. Why not? So I would, in case of this small one, I would rather do a call spread. Ramesh, I have 100 shares to cover. Yeah, but not for Google. So Google could do an iron condor. Sell a put spread and maybe go and sell a low delta call spread. I mean, I have Mercado Libre. So you all know, I've been talking about it. I don't have 100 of it. So what I generally will do, and I think right now probably I have a trade on Mercado Libre, is a sell a put and a call spread against it. So if I remove the shares, so this is the option position which I have on Mercado Libre. Even though I'm bullish on Mercado, I hold Mercado Libre. Still, it's right now it's about 790. I still want to contain my risk a little bit and sell a call spread rather than going naked on it. I don't know what might happen in next, this is June expiration. So what might happen in next 1 month? I have no idea. Peloton. So I know Peloton is looking to sell themselves. The reason they want to sell themselves is they're running out of money. No more operating income. And so they have to raise cash, and they're looking for a suitable buyer to come and buy them. Who will buy them? Can Apple buy them? Possible. They could be possible sooner. Because one thing is true on Peloton, they have the consumers of Peloton and customers of Apple and customers of Peloton have a similar traits. They both are very dedicated or devoted, very loyal to the company. So if you look at the Peloton, again, I've not gone into the details. I just heard it on some podcast. Even though the Peloton is a very bad situation in terms of their revenue is low, they're running out of money. Only silver lining is the current customers, the renewal rate of the current customers are still very high. So the customers that they currently have are very loyal to them. They're not able to get a new customers. They're not able to, fund for their expansions, etc. That's why they wanted to sell themselves a portion of its equity to raise more funds. But their customer base is very loyal to them, just like Apple. So maybe the question is, would Apple want to buy? Dave has been day trading Macy's. Look at the weekly chart. It's been box 22 to 28 until it is not. Selling naked short strangle 22 put 28 calls of Macy's. Macy's is M. Right? Yeah, this has been that option seller just dream. Yeah, this is a dream come true. Just being range bound. Keep selling strangles on it. These are a big chunk of my daily profit come for day trading Tesla. Yeah, Tesla is very risky. This whole Elon Musk antics is just keeping away from Tesla. I don't know. I just don't have any faith on Elon, especially now what he has done with Twitter also. Jets. Oh, since December. Yeah, so Jets has been in range bound between 19 and 22. So because Tesla came out, one other story I just want to share is around, and then we will. The session is around Tesla's, not Tesla, but the Twitter, Rama. If you hold Twitter in your portfolio, I know someone asked that should we buy Twitter now because Elon is gonna buy it at $52.40. Sorry, $54.20, and trying to do an arbitrage. I would rather say if you want to do an arbitrage, go with Warren Buffett. Take an arbitrage on Activision Blizzard, because wherever Elon is involved, you never know what's going to happen tomorrow. And that's exactly what we saw. So as you all know, first he announced the plans to acquire Twitter. And then this was his plan, what he wanted to do with Twitter. Increase annual revenue to a $26 billion from where it is in $5 billion, right? Increase it 5 times. Increase the users to almost 1 billion users from close to 200 million. 5 times increase in the number of users, 5 times increase in revenue. I mean, it doesn't cost them for Elon to say these numbers. You can always say these numbers. Increase the ARPU. Right now, Twitter makes 90% of his money from advertising. And he says, I want to reduce the the reliance on advertising. Now, but without having any good subscription service, I don't know how you're going to do that. But anyway, he says to do all this, we need to fire some employees next year, bring down the total. Thursday, Twitter CEO also fired 2 top execs, announced freeze on hiring. He fired consumer product leader. He fired a GM of revenue and a head of product on the business side. 2 key people he fired, and says we are not hiring anymore. Essentially playing to the tune of Elon Musk, preparing a company to be handed over to Mr. Musk. Did on Thursday and Friday, Elon flipped. He says temporary on hold. Now we want to find out the details of scam accounts and the fake accounts, as if he didn't know about this sooner, as if this was a surprise for him. Come on. But this is why, all the respect for what he's done with Tesla, SpaceX, but I was zero respect for him as a corporate CEO. He's a maverick inventor. Love him for that, but not for his corporate CEO like quality. So flip back saying, hey, I want to really check if the spam accounts is less than 5% of users. We saw similar stuff on or during as a Bitcoin, right? He flipped back saying, oh, the Bitcoin is now polluting the world, as if there was something new that came up within a month. Nothing, right? So sure, the investors would have puked on his involvement in Twitter. Maybe he's looking a way to get out of Twitter without paying $1 billion worth of the breaking of fee. Who knows what the real motive is? Is he freaking out because have the investors freaked out because he had to pledge his his Tesla shares to raise the billions of dollars that he needs to fund his Twitter acquisition? Possible. But now the Twitter acquisition is back into question and the share dropped by another 10%. So yeah, this is, want to take an arbitrage? This is playing with fire when Elon is involved. Either it's going to give you huge upside, or you're gonna, or it's going to not mean anything. And it's not going to be, let me put it this, it's not going to be a smooth sailing when you're sailing with Elon Musk. So be careful. But arbitrage on Activision Blizzard, maybe a gamble worth taking. At least you have a Warren Buffett on your side. Still 77. Right. I see a question, Sandra. Do you have a crypto Thursday? Probably not. I don't see most folks joining in, so we'll cancel the Thursday one.
Vivek,
yeah,
I don't understand Activision. Doesn't Microsoft already have a price?
Yeah, Microsoft says right $96.
So, okay, I didn't understand that because
so
okay.
that's what we talked about last week. Also, there is an arbitrage opportunity that if Microsoft is able to close the deal, Microsoft will buy the shares at 96, and currently the shares are 77. So you can buy the shares at 77 today, assuming, having faith that Microsoft will be able to go through all the regulatory hurdles and be able to close the deal, and they will buy it at 96. So you get $20 profit on $77 worth of investment. Pretty good deal, considering Microsoft will close it in 2023, I think mid of 2023. That's what Warren Buffett is betting on. He bought almost 10% of Activision Blizzard's shares, because he thinks that Microsoft will be able to close the deal. Microsoft knows how to deal with the regulators. The rest of the market doesn't think That is why the rest of the market hasn't pushed this up. That is why this arbitrage opportunity, oh, we can do like this on Finviz. That is why the rest of the market is still keeping it at 77, because they perceive there's a risk that this deal may not close. If the deal doesn't close, it'll come back to maybe where it was or maybe lower. Because right now, all the tech companies are being taken to cleaners, are being taken to task. So if the deal doesn't work out, it might fall down to who, God knows where. So that's a risk if deal doesn't work out. But Warren Buffett thinks deal will work out, and 96 is the deal that Microsoft will honor, because maybe Satya Nadella, he's not like Musk. He will honor the price that they have agreed on to. And I also checked, was it a cash deal or a stock deal? It is all, if I recall, it is all cash deal. Oh, if someone already knows, is it all cash or is it cash and stock? All cash deal. So I don't have to worry about Microsoft owning Microsoft stock if I don't want to own, or the stock going down. It's an all cash deal. So now, if you think the market is right and deal may not close, then the stock will come down. Okay, don't take the arbitrage. But if you think Warren Buffett may be right and it will eventually, Microsoft will pay $96 for it, take the arbitrage. Again, not an investment advice. I'm just giving the both sides of all these deals, both scenarios on what may or may not happen. Cool. All right, so next week we will talk about portfolio protection strategies. That will dig a little more deeper into options. Talk about call spreads, call ratio spreads. Or if there's another topic you're interested in to cover on options. I thought, given what's happening in the markets, if you know how to get a little protection, and again, it might help us to stay longer in the market. So I thought I'll share that. But
do you do any what is that, synthetic long stock?
Synthetic long, yes. So that's my synthetic long stock. I think I have only 3 or 4 where I have 100 delta. I have 2 ways, right? Either I'll do a short put and a long call, get 100 delta synthetic stock, or I'll do deep in the money 80 plus 90 plus delta leap option as a synthetic or stock replacement. Those are my 2 go-to trades for synthetic stock. But yeah, I do have some.
Do you do that, or do you do a sell put spread and use the proceeds of the credit to buy the call, or do you just do the naked short put and naked long call?
So see, depends on how much delta do I want to take. If I'm firmly bullish on it, on some stock, and I want to take 100 delta, in that case I will do synthetic stock substitution, sell at the money put, and then buy at the money call. That gives me 100 delta, right?
Same expiration or different expiration?
Same expiration.
Okay.
Right. So generally I'll take that position. I will do that only for capital efficiency perspective. Means I want to have a exposure, stock like exposure for next 1 to 2 years, right? Then I'll go far out, look at a leap, either leap option or buy this create a synthetic stock position. Most of the time, I probably will not be doing this because I always want to give myself room for error. I did some of these synthetic stock positions when the market fell down 30% in 2020. Because on some stocks I thought, oh gosh, it's too much. Eventually it's a COVID is just a disease. We'll figure it out. I was wrong. We didn't figure it out. It took us 2 years to figure out what the COVID was. But some of those positions had really worked out well. But because I wanted to go, 100%, have 100 deltas on those stocks.
But
Generally,
would you consider doing that right now for SPY and QQQ? Maybe selling the 2024 options? Or is
so
it too
right, no,
premature right now,
SPY,
right?
no, no. So right now I'm using SPY and QQQ only to do my hedging trades.
I see.
Because right now, if I'm doing any bullish trade, I am doing it on individual stocks that have gone beaten up, but are generating cash, like Google is generating a good amount of a cash. Companies that have a stronger balance sheet, much bigger moat over a long term, but then got beaten up by, let me share one screen, beaten up by in the recent times, right? So for example, this one, large cap companies, sales is growing 40% over past 5 years, have operating margin, positive operating margin, but are down 50% or more from their recent highs, from their recent highs. It does throw me these numbers. Right? Now I can say, okay, if you really want to open a position in trade desk, I know it is not a love name. All these are being pretty much beaten up, these stocks. In this case, maybe I'll sell a put spread on this, because I think from a business perspective, they are good. They are operating margin positive. The sales revenue has been growing and has been beaten up 50% or below.
Oh, this is good. Hey, are you able to get the fetch data from Finviz, kind of like a Yahoo Finance API? Do they have APIs and you can fetch data from here?
I don't know. I mean, I haven't built. I don't. So I didn't look at if Finviz provides a API or not. Probably it must be, because there is some back test. I don't know. You can check it out.
Is this a free version or the paid version?
No, this is a paid version. Free version, you get a lot of ads, so which is very distracting. So
is your options gig website still working?
Yeah, that website is still working. Yes.
Yeah, because I brought in Lalit and also Ayaz Shah. I mean, he's actually Nomi, right? They're both in here. They're very interested in your presentation. They love it. It's awesome.
Oh, okay. Oh, I appreciate that. So if Lalit and Ayaz, if you're new to options, I would recommend. I don't do those boot camps anymore, but the videos are available for free on the website. The boot camp videos. So hold on, let me.
And Nomi is actually Nomi and Lali. They know options very well.
Okay, that is fine. Then I don't have to talk about it.
No, but if you do have it, I wouldn't mind having refreshers though. Your view might be slightly different. We've done quite a bit.
Yeah, so mine is basically more focused on the retail side, because again, I am a retail investor. I'm not a full-time trader. So you can come to boot camp. And
Ayaz is a full-time day trader.
Yeah. So you guys can teach me a lot of stuff on more on the technicals and on using option on day-to-day basis side of that.
Yeah, I'm like, the fundamentals for me, man.
Yeah, see, that's why we are here to learn from them. I'm like, I put my trade and then I around good thing that I'm on the West Coast, so it's like a 6:30 market will start. I'll do what I have to do between 6:30, 7:30, 8 o'clock. My office work starts and then I'm gone. So I can't do
it's awesome for you guys, man. You're 3 hours behind, which means you can trade and still go to the office and work, right?
Yeah. So I can't do any kind of a trades which I have to watch. So I don't do weekly trades because the gamma risk is too high. So I don't do. I try to stick to monthlies.
That's where you make the big bucks, right? Swing traders are the ones who making the most, right? Day trading is very, very attractive, but you also lose a lot of money too.
Yeah. So anyway, the reason why I'm got into investment, and I've shared that earlier, is to get more financial independence so that I can do what I want to do, when I want to do, and how much ever I want to do. I don't want the investment to become my master, that now, gosh, I have to watch it today. So for example, this week I was busy because we had a company offsite and the markets are on fire. It's okay. Portfolio is down, that's fine. No margin calls, nothing else. Same thing during COVID. we're in an office and then market goes down 35%. I don't have to worry about it. So I stay in that way, that this becomes this is my supplementary income, side income. I don't want it to control my schedule. Then I've substituted one boss with another. I don't want to do that. So cool. Well, so I think that's it for today. Next week, we will talk about portfolio protection strategies, focus on some concepts like deltas, portfolio beta-weighted deltas. What are the strategies you can use to reduce your deltas at individual trade level, at a ticker level, and finally at a portfolio level. But if it's the same stuff which I had covered here in number 13, portfolio hedging. So if you want to go through it prior to that, or want to skip, that's the same stuff I'm going to talk about now. So this is which talked about last year, April. So I haven't done any boot camp since then. So I thought, given the fact what's happening in the market, it'll be good to go through the hedging concepts once again. All right, you're welcome, Dave. Good to see you back here. All right. Yeah, so we will not have any crypto sessions because, as always, I think people get attracted towards any kind of a market if it continues to go higher. And I don't see much participation on the crypto side. So I would rather save, my 2 hours and do something else. So rather than spending time when there's not enough interest in the particular subject. But if a specific question on crypto, let's bring it up here. We can spend 10-15 minutes on the crypto in Saturday meeting itself. Cool. All right, guys. Thanks, everyone. You guys have a wonderful, wonderful weekend. Let's hope the markets will do better next week. But even if it doesn't, it's still okay. World is not gonna fall in. We're gonna look at some of the great companies that we looked at last week. Talked about some of them. Continue to build positions in that. Cool. Thank you.